What's up, guys? Jeremy here with another video. Hey, real quick before I get into this, I just want to say thank you so much to anyone who has subscribed. Thank you to anyone that likes this video or comments. Thank you to anyone that has entrusted me to manage money on your behalf or who has hired me as your financial coach. I just want to say thank you so much to everyone who has supported me in this financial entrepreneurship journey. With that, let's get into this video. What is GameStop's fair valuation? Now, a couple videos ago, I talked about from a price to book basis how you could value the company. Today, we're going to get into a price to earnings basis, which is a more common way of valuing a company. But let's go ahead and recap real quick the price to book. Check this out. I figured out how to make my screen a little bit more visible for you guys. So hopefully you appreciate that. We've got on a price to book basis, GME at a 1.88 right now. And I think a closer to fair valuation is more like a 19, which would put them at about $122 billion. And maybe one day they get closer to a 35 as they skew more and more online and reduce their physical footprint more and more, which would put them at a $225 billion valuation. So if you missed that last video, feel free to get to it. But somewhere between a 125 to $225 billion valuation compared to its current market cap today of 12 billion. So some pretty high upside, right? A 10x to a 20x upside with what as a downside? I mean, how low do you think this price to book is really going to get for a company that is in many ways competitively in an advantageous position compared to some of these other retailers? So, and of course, the S&P 500 benchmark is just at 20 billion. And this price to book, one other thing I just want to say on this is a moving target. And guess what? GameStop's book value is increasing dramatically year over year. It's highly likely that their book value is higher by the end of the year than it is today, and that they have more like $10 billion in the bank versus the 6.2 that they have today. And so again, these numbers, the 125 to 225, well, that might be a time and a half what by the end of the year what it is today. So this is just based on today, right now, their market cap, right? So let's go into the price to earnings. The first thing we got to do here, and my most recent GameStop video, I boiled down their 10K. I highlighted how their core business is operationally profitable. Right here, what we got to do is we have to kind of estimate how profitable is their core business right now. So I'm not trying to project new performance or outperformance here. Let's put some numbers to what I discussed in my most recent video, which is, okay, hey, here's the starting operational loss. So they are net income profitable as a company. Set that aside for right now. We're just talking operational profits from GameStop, the retailer, not factoring in any interest income from their cash pile. Some steps that we talked about that we know they're going to do this year. They are going to sell France and Canada. That is $48 million of losses that we can then reverse when we're thinking about their 2025 year. Let's go ahead and assume that before long they close Australia also. And let's say that they close some unprofitable US stores. Now we know that in the United States as a whole they are profitable, but they've got 2,300 stores at the end of 2024, and up to 1,600 of those are up for lease renewal in just 2025 alone. So this is probably a conservative number, but I'm assuming, hey, they will indeed have some stores that are unprofitable in the US that they can close. And then we're going to net out the costs of closing stores. So I can get into the factor of this estimate in a different video if you want to get into the weeds. But this is my best guess of what they spent on just on one-time store closure costs. They closed almost 1,000 stores in 2024. That is expensive, right? So basically, I'm saying they spent $150 million closing stores that we can back that out because it's a one-time expense. It's not fundamentally an expense tied to what is moving forward their core business operation or 1.5 million per store. Um, Now, that gets you an operational earnings of 200 million. So, what else can we kind of map out as far as their current business? And this maybe gets a little bit into projecting forward. But if you read their 10K, they have this other category in SG&A that I'm assuming will continue to come down just on the same trend that it has, as well as the SG&A per store decrease. It will continue to come down as it has. And then this might be confusing, but I'm estimating, guesstimating, right? I'm just throwing this out there as a hypothetical. I don't want to get super in the weeds of these specific numbers, but a 20% revenue per store increase, assuming that by the end of 2025, they have 1,800 stores left to their name. Maybe they have more than that. If they have more, then this would be even better. If they have less, it'd be slightly less impactful. But this might sound like a little bit of semantics, but I'm not expecting them to do 20% better as a core business. What I'm saying is if 2025 happened to land in 2024, their their financials would have been about 20% better in 2024. It's related to what video games come out, what consoles come out. And 2023 was many people would say the best year in video games in many years, maybe ever. 2024 was historically weak. I mean, just not very many releases at all from a new games perspective. And neither of those years had any new consoles come out. In fact, the most recent new consoles were in 2020. So you're talking about 4-year-old consoles is the most exciting console anyone can buy. In 2025, you've got the Switch 2 coming out. You also have Xbox that's going to make their own handheld console in 2025. And you have an epic, epic rundown of video games that are coming out in 2025. So, again, this might sound like semantics, but what I'm trying to say is GameStop doesn't have to get better to benefit from what we know is already here. It's already happening. Hey, there's a wider array of compelling products for GameStop to sell, even if GameStop doesn't find out any new ways to make money as a business. Their business, as is, will make more money in 2025 per store on a revenue basis than it did in 2024. So you put it all together, their business right now, they're currently operating business, you could say, hey, approximate, right, ballpark-ish. Let's just say their core business makes about $270 million per year. Obviously, down the road, I think it will be more than that, but we're just trying to talk about present day, what are they worth? Normally, when you value a company, by the way, you would discount their future earnings into a present day value. That would be helpful for GameStop if we also did that. That would probably support their PE ratio, their valuation even more. But from a PE basis, you're really looking present day and past, not so much trying to project out forward earnings or future earnings. And so part of me is just trying to stay true to the PE ratio. Another part of me says, hey, we don't really know what will all those core drivers be. It's hard to assume a long-term growth rate to GameStop compared to a tech company or a company that has a 5 or a 10 or a 20-year plan in place that we know will materialize or we think we can project will materialize on a certain growth curve. And by that future cash flow generation, we can value the present day worth of the company. GameStop has not disclosed their future revenue drivers from a clear enough perspective for us to value their growth rate yet. But Let's just roll with this. Operating earnings. So, how do you value the company from their earnings? Well, so I think here's our 269, right? We just pulled it from right there. Say, hey, they make $270 million, which is just kind of a base case if they just cut out some of the fluff and they just keep doing what they're doing, not assuming they get better at all. Now, so that's one number is what is their earnings? And then the PE, right? What multiple do you ascribe to GameStop, the business? And you can decide for yourself, okay, what multiple you want to give GameStop. Here's some industry comparisons. You've got Best Buy and Ulta, which are declining retailers. Their future is uncertain to a certain extent at a 14.5 PE. So if you said, hey, that is the category that I want to put GameStop in, you would say their core business has a $4 billion valuation, right? A $3.9 billion valuation. It's just taking this number and multiplying it by that number, right? You could say maybe they're an AutoZone or a Home Depot, just a steady retailer. That'd put them at a PE of 23, a valuation of 6 bill. You could say they are a growth retailer. TJ Maxx and Burlington's discount retailers have seen a lot of growth in recent years as more and more people get burned by inflation. And you could say, you know what? I think GameStop is a growth retailer and they're at a 29. Or you could say, hey, Chewy, online retailer, or Costco, an explosive growth retailer. Thanks to food prices escalating dramatically and Costco relative to the grocery industry, keeping their prices lower, it has made a Costco membership that much more compelling to people. And so here they are at a 55 PE as they've grown on an explosive curve recently. If you think, hey, GameStop's in an explosive growth industry or they have explosive growth ahead of them, then you'd say their retail business is worth 15 billion. Now, deciding on a PE for GameStop present day versus future is a, that's part of the dance, right, of valuing a company. And I will say that if your future is certain, you might as well treat it as present day. If you wait for the future to become the past and you only want to see it happen once it's already happened and then make your decision, at that point, that's probably going to be baked into their valuation. You're probably going to be too late. But at the same time, you do want to be level-headed. You want to be mindful that the future is not the present. Nothing is certain about even the past, much less the future. And so you want to be cautiously optimistic, I guess you could say, calculated in how you determine a retailer. Now, I would say right now, we know from their 10K that GameStop's operational profitability, while new, right, they were operationally in the red for years. They were they have each year improved like by many millions of dollars year over year, right? From deep in the red to less deep in the red to barely in the red to barely profitable to now a decent profit, and we'll see how far it goes. So you could say, hey, that sounds to me like a growth retailer. I know it might not sound or look like a growth retailer yet. I'd say, hey, net income growing considerably year over year for several years now. I would call that a growth retailer. Now, the sector, it becomes complex, right? Because this sector, we would say, oh, video games, is that really a growth sector? And I would say, yeah, it's the video game industry as a whole is huge, over $200 billion, and projected to quadruple in the next like 6 years or something like that, maybe 9 years. In not a lot of time, it's going to grow even more. It's a huge industry and a growing industry. So that works to GameStop's favor, but of course there's this ominous monkey on GameStop's back of, but are physical discs in the future of the video game landscape? And that's again, you could project forward what will happen many years from now, where you could just look at the present. And right now we're looking at the present and saying, yes, it is a part of the landscape. And actually, it's an increasingly profitable business, right? And we'll see in this calendar year, we'll see that revenue per store growth increase as well, particularly as the collectibles market grows as well. I think there will be a used video game market for many, many years to come. But I don't think, um, I think GameStop has plenty of time to continue to iterate their business to where they, again, they don't have to live and die by the floppy disk. But regardless, you could say, hey, they might have a growth business, but they're in a industry that's a growth industry, which is also good. And I'd say they are increasingly becoming an online retailer, right? They're decreasing their physical footprint more and more and more to where they're becoming much more similar to a Chewy from a total total leasable space, total storefront space available. They're becoming smaller and smaller to the point where they're more and more say, hey, maybe they should have more of an online price to earnings, a more efficient, high margin type of valuation. They're not there yet, but it seems to be the direction they're moving towards. Regardless, all those things, bullish, bullish, bullish. You could say, hey, video games, maybe it's a declining uh, product mix, a declining inventory that they're selling. I will say that's highly debated what the future of video games holds related to is it all digital or do we actually see a swing back to physical as people appreciate having ownership of their ability to play a game or not, as well as the collector value. I don't want to get into the weeds of that, but overall, I'd say worst case, you would call it steady, taking all those tailwinds, netting that headwind, but probably more like a growth from a PE basis, and maybe in the future closer to an online. Now, let's keep going. Have I lost you yet? Because their earnings could outperform, right? They might not just be the base case. They might say, hey, what if they actually earn 50% more than we realize? What if a lot of their earnings have been suppressed by unprofitable stores and the high costs of closing those stores? And actually, when you're on the other side of that, you're going to see earnings dramatically increase. Now, again, you apply those multiples and you say, okay, maybe it's somewhere between a 9 to a $14 billion business. And now you have, well, what if they become a cultural movement? And for this, I said, what if their earnings is three times what we're projecting it to be? What if they're actually three times as profitable? You see just a notable uptick in their sales, like an explosive growth, right, in their revenue. Now, this one's kind of interesting because if this happened and they're having explosive growth, it becomes a snowball that can avalanche because now you're talking about being priced like an explosive growth retailer. And so now not only is your earnings higher, but your PE is also going to be even higher, most likely. So if you have explosive growth from an earnings perspective, it's more likely that you might even have an explosive growth PE. You could be as much as a $66 billion valuation. And this is really kind of like a present day or a 1 year out type of estimate. This isn't even talking about the nuts and bolts of improving their business. Now, this one is a little bit pie in the sky because why would they just suddenly become a cultural movement? And I would not ascribe a high likelihood to this, but it is it's a non-zero chance, and it's really related to GameStop stock and its role in financial markets. Right now, that story is still unfolding, and so it's nothing right now. It's nothing. But it's possible that GameStop becomes culturally iconic, not as haha, the meme stock, the dead company, but actually triumphantly like, hey, this is the last stand that gave power to the players, right? That's literally GameStop's slogan. And as it relates to finances, they might be a part of shifting the power of markets from highly concentrated super wealth hedge funds and financial institutions to actually creating maybe even a blockchain based uh, stock market where now so many of the mechanical problems within our stock market become neutralized and everyone can just own companies and know that there's no funny business going on behind the company. That's really in the weeds for this. But to put it shortly, if intense corruption gets exposed on Wall Street and simultaneously GameStop stock skyrockets in value, say 10,000%, then I think you will see a potential that their sales goes up considerably. And initially, that financial news will probably be quite villainous towards GameStop, but eventually, as more people become educated, similar to a 2008, they figure out what really happened, etc. GameStop certainly could come out of that rubble as a hero retailer in people's minds. So, maybe highest case, best case in a medium term scenario, you're looking at a $66 billion company. Okay, but here's the thing. Plus, so that we just talked about GameStop's core business, but remember, we left out their net income. We left out their interest income. We left out what? GameStop, the hedge fund. We took their cash and their earnings from cash and we said, let's value that as a separate business. It's not fundamentally important to GameStop, the retailer. So let's talk about what's GameStop, the hedge fund worth. Now, they've got in an assets under management basis, a little over 6 bill, separate from their retail business, right? This is just them, the asset manager. Now, what's their earnings from 6 billion that they manage? Well, so far it's just been at the T-bill rate, 4.3%. And what's the price to earnings ratio in the asset management sector? There's a wide range. There's a wide range. You've got a 13 from a Carlyle group that mainly does lending and ETFs of that nature, all the way up to maybe a 60 in a CVC or an Eris. Or what about maybe Ryan Cohen, the CIO, the CEO, the owner, and multi-billionaire leader of GameStop himself? Is it possible that he could even command a higher PE than what we see in some of these mega-sized financial institutions, many of which really operate ETFs? So they sell their financial products to institutions, maybe a financial advisor that doesn't want to actively manage. They might say, hey, let me pick some of BlackRock's ETFs and do that for my clients, right? So a lot of these asset managers are private equity. A lot of them are institutional and not necessarily direct to the customer. But regardless, high range of PE ratios and what you would describe as fair becomes that much more subjective. And I will say that as it relates to asset management, there's some benefit to being large, but there's also a lot of limitations to being large. Warren Buffett has talked about this plenty, how much easier it is to make money when you're small than it is when you're large. So GameStop with a $6 billion valuation, or let's say by the end of the year that's 10 billion, the multiple they could command on that and really probably should command on that is potentially higher than it could be forever. You know, the growth from 10 billion in AUM to 100 billion might command a pretty high PE, but from 100 billion to 500 billion, even though their earnings will be going up substantially, their PE might be kind of coming down as they scale up that arc of size because there's just only so many companies you can own. Now, why might Ryan Cohen command a higher PE than some of these generalized ETF fund managers? It just comes down to his ability to make a return on the money. So if all he ever does is own T-bills, there's no reason why he would have a PE that's above industry averages. But we know that that's not his intention. He's made it clear that he does intend to deploy this cash into expansive opportunities in a private equity deal, right? To M&A, to acquire companies that he thinks will add more value than the cost that he spent on the company. And you're talking about a guy who has actively managed his investments himself. And what I mean by that is he founded Chewy. It's now a multi-billion-dollar company. And now he has essentially refounded or transformed GameStop as an owner of each of these companies. So and not just an owner, but an operator. Warren Buffett, on the other hand, he'll own a company, but he notoriously does not meddle with the management of the company. Ryan Cohen's really an entrepreneur at heart. And so if he buys into a company, well, that company is not just getting his money, and it's not just getting his branding, it's not just getting his, growing kind of cult following of retail investors. It's also getting him, the operator. It's getting his work and his expertise, most likely. And so that's one reason that you might see a higher multiple put onto Ryan Cohen's investments compared to just a super broad market index type of asset manager. Now, where you pick as far as a PE for GameStop's hedge fund business is your choice. But on the low end, you'd say the very, very low end, 3.5 billion. I would tell you this is really too low of a low end because this is worth less than the cash itself. So obviously, the earnings on T-bills as a business is not a compelling business, right? You would be lucky for your business to be worth more than the cash itself. But I'd say from a fair value perspective, you wouldn't really see this cash be valued really any less than two times the cash value, but you could say conservatively 1.5 times the cash value. Certainly in a liquidation scenario, it is worth 100% of the cash value. So again, if all they ever do is T-bills, their hedge fund is worth somewhere between 6 to 10 billion, depending on if you value the cash at just 1x or maybe closer to 2x, like a 12 or 13 billion. But what if they make some more money with this cash? Which so far they haven't, right? They've used the cash to generate income to support that retail business transformation that we've been talking about. But now their retail business transformation is coming on the tail end. This year is a significant year, almost like a nail in the coffin or a statement year towards how many stores they want to close out, an aggressive closure year, an expensive year. So they're holding on to that cash to pay for those store closures. But pretty soon that cash is going to get liquidated, or I shouldn't say liquidated, but some of that cash is going to be deployed. Particularly if we see a stock market crash, you're going to see favorable buying opportunities there. But we know kind of on a base level, GameStop has expressed interest in investing some portion of its cash into Bitcoin. And let's just say, regardless of how exactly they deploy the cash, whether it's some marketable securities that they buy at a discount, some Bitcoin, whatever, let's just say they generate a 10% ROI, just a standard index S&P rate of return, which in reality it would be more like hey, GameStop is putting some portion into Bitcoin, which is hypothetically appreciating it beyond 10% or whatever they're investing in. and some portion is still in cash at that 4.5%. Let's just say weighted average 10% return. Okay, well, now you're looking at anywhere from an 8 to a $50 billion business. Now let's talk about M&A. Or what if they're able to generate a 20% return, which maybe they can't do forever, but maybe they could sustain for many years until their AUM is substantially larger than it is today. Well, now you're talking about a 16 to a $106 billion business from GameStop, the hedge fund. And again, as I mentioned at the beginning of this video, they probably are going to have even more assets under management at the end of this year than they do now. So what if that number, that six, is actually a 10, right? 10 billion. 1, 2, 3, 1, 2, 3, 1, 2, 3. Is that how that works? Well, now it's anywhere from, a 13-ish to $170 billion business. And that's feasible for this year that they accomplish that they raise that much more. And why is that feasible? Because we've seen it. We've seen them be able to do it, and the reason they've been able to do it is likely related to an insane amount of legacy short sellers that shorted their core business that we talked about earlier. But as soon as the core business became profitable, these legacy short sellers are needing out of their shorts, but they are so deep in their shorts. I don't think we'll ever know just how deep they got because they used ETFs and derivatives and several skewing factors to hide a lot of the implied short interest. But regardless, basically these businesses are paying GameStop, but like because GameStop has shored up the core business, they are now paying GameStop billions and billions of dollars to launch their hedge fund business. And now GameStop has two bona fide businesses that hold substantial value. So let's put it together from a PE basis. First, let's look at their floor valuation. What's the worst case? How low could they be worth? Their cash at a 1.5 face value and their core business at the base case at the lowest market cap or at the lowest multiple. That puts them at a $13 billion market cap or about $30 a share is the worst case valuation for GameStop on, let's say, a 1 year from now basis. So anything below 30, anything in the 20s, it is a steal. It is a steal. Now, what's a fair value? Again, feel free to to go back on this video and look at some of those matrices, but from a super high level, super rough brush, it's about a $40 billion business or about $90 a share. The implied move from its current price, that's beyond a triple of their current price. And that would be a fair value. So if they're at $40 a share, should you sell every single share and say, "Oh my gosh, this is crazy. This is a squeeze"? Well, you can if you want to, but it's well within fair as far as what does their business support. And what's the upside scenario? This isn't even the upside. This $90, this is, hey, a year from now, 18 months from now, it would almost be surprising if they were not valued this way. Now I'm talking about their real 2024 numbers as we back out some of these one-time expenses, but it's not going to be until they file their full year 2025 numbers a year from now that we find out how accurate are my assumptions, what else happens, how much money do they raise, etc. So valuation is always for a legacy business is always backdated. It's always looking backwards. It's always hindsight valuation, rear view valuation. But the more and more that you're a growth company, the more that it becomes a forward-looking valuation. And GameStop right now is slowly beginning that transition, but right now they are still in the legacy hindsight valuation reality. And so they are having to prove it every single penny of the way as far as their fair value. But I'm just telling you, this is this is fair value for GameStop. This is not a crazy scenario. This is a fair scenario. What's their fly valuation? Well, we looked at it, 106 billion for their hedge fund, 67 billion for their core business, a 173 billion dollar market cap is best case scenario. It's not best case. I mean, they could just have on a technical basis, they could have a short squeeze that launches them way past 200 billion. They could be a $2 trillion valuation if all you're talking about is implied short interest and a short squeeze, and how insane could that uh, how insane of a situation could that create for their stock price? But I'm just talking about from a PE basis, best case scenario from the implied valuation based on the earnings they can generate, $173 billion. Now, obviously, that is a 1,300% price increase. That's almost $400 per share that you're talking about as far as hey, what's really the best case of what GameStop's worth, say, a year from now? A year from now. Now, we talked about the price to book, a 125 to 225 billion dollar valuation. Their price to earnings, putting them at a 40 to 175 billion dollar valuation. Are you getting uh, attuned to the trend here, right? Massive upside. And the downside is, oh, still higher than where it is right now. I wish I could compare this to every company in the world. Soon I'm going to make a comparison of GameStop to Berkshire Hathaway and show you why GameStop is a much safer business investment decision than Berkshire Hathaway, in my opinion. But I'll save that for another video. One other thing I want to highlight is that this is just a 1 year out valuation, a present day valuation. What we can see, this is not valuing their growth in terms of what do they do from there. Well, they could become a $175 billion valuation company. It doesn't mean they're stuck at 175. It means we need to reevaluate. Well, now how much do they have in assets under management? Now, what should their multiple be? Now, how many businesses have they acquired? What are the upsides of those businesses, right? You're always evaluating fundamentally what you can see and what you can project with a high level of clarity. Right now, we can project with a high level of clarity upwards of $175 billion in market cap, which is crazy, right? And we're not talking about short interest. We're not talking about a squeeze. That's the crazier thing. But if they then are a $100 billion, or even if they're a $50 billion company a year from now, that doesn't mean they're limited. It means, okay, now what? And for reference, Berkshire Hathaway is a $1.2 trillion company. So that would still be a 6x from the best case market cap we're talking about a year from now. And all that to say, you might not want to sell too early. You might not want to sell too early. But hey, none of this is financial advice. Okay, I'm just giving you guys a thought exercise here on how do you value a company from a price to earnings basis, which is in many ways the most common way to value a company. The more and more that they are a growth oriented company, the more you might start talking about price to sales. But price to book and price to earnings are maybe more common as it relates to a legacy business. We don't have a lot of clarity on what the extent of the transformations will be from GameStop's core business. But I'm talking about even if they don't transform the core business, just valuing their core business and valuing their hedge fund business, we can derive a pretty high floor. The worst case scenario is essentially non-existent related to if you were to buy in today or at any point in the 20s, and their upside is astronomical. Astronomical upside. Crazy, crazy upside. But again, not financial advice. I am a financial advisor though. If you need any help making financial decisions, feel free to reach out to me. Um, because again, you can hear me talk about a company that I like, but to get into the weeds of, well, should you own this company or not? There's a lot of factors there. And if you should own it, what weight should you put into it? And even if you have a weight into it, should you maybe sell at certain points and then buy back at certain points? Right? There's a lot that goes into managing a portfolio, and I would love to talk with you about how I might be able to help you with that. But regardless, I just want to say thanks so much for watching this video. If you like content like this kind of nerdy, deep dive type content, I would love to know. And thanks again for y'all's support. I'll talk to you soon.